Welcome to PitchBook's Visible Capital podcast, where we use data, research, and conversation to reveal important trends and issues in the private markets.
Welcome, everyone, to the Visible Capital podcast. We're devoting Season 1 to examining the private markets by discussing the work of PitchBook analysts and writers during the COVID-19 pandemic. I'm Adam Lewis, a private equity reporter for the PitchBook newsletter.
And I'm Adley Bowden, head of our editorial and institutional research groups. Today, we're joined by Dan Cook, lead of our data analyst team, and Andy White, senior analyst on the same data analyst team, to discuss PitchBook's new quantitative reports and specifically the VC one that we put out recently. Welcome, guys.
Thanks for having us.
Yeah, thanks for having us.
Maybe just before we get into the reports themselves, Dan, you can give us an overview of your team and what the focus is at PitchBook.
My kind of tagline for the team is basically that we specialize in using our data any way that it can be used. We produce all of the data that powers our reports. We're intensely familiar with our methodologies and our data sets and really all of their use cases. So with the Quant Perspectives reports, we saw an opportunity to apply a little bit more rigorous data and statistics practices to some of our research. Specifically applying some regressions to come up with some projections and give people a better idea of what to expect, in the coming quarters.
And so these reports are new. What was the idea behind these reports, the genesis of them that you're trying to get across?
Yeah, the genesis was really a conversation that I had with our director, Nizar, who pushed me to, as we're publishing this content on the pandemic and takeaways for our clients, to look at what our other clients were asking of us, what kind of data sets were relevant to their workflows, and can we start to be proactive in pushing that stuff to be in front of them. That quickly morphed into an effort to create a narrative around those data sets and really highlight the connectivity between those data sets and how they relate to one another. And ultimately decided the best way to get that out the door was in this format of a kind of visual narrative, setting the scene at a macro level, and then dives into PitchBook's data, looking at what happened in the last downturn and how it might be relevant to this one.
Yeah, I would just add also to that, I think these are the types of reports that we've probably had our eye on for a number of years now. And as with kind of many things, this current moment has kind of given us a shove in the direction of we have a sort of situation where it warrants content like this. So let's take advantage of that, and let's put some quantitative backing behind some of the things that we're seeing in the market. And just to echo Dan, I mean, it's really about visual storytelling, right? And that's kind of we're the data experts, and so we want to be able to kind of up our game as far as how we can use data-driven visuals to actually communicate a narrative and a story about what's going on and maybe what folks can expect in the future.
Yeah, Andy, one narrative you guys go into pretty deeply is the impact that the COVID-19 pandemic will have on company valuations at the VC level. I mean, what did you find there?
Yeah, I mean, it's a tricky question to answer, right? Because particularly in the VC space, you have, and particularly at the early stages, you have investors sort of getting approached by companies and having to come up with what they believe is a fair valuation for the company. In traditional finance, you have some hard cash flow metrics to look at and market size and all these different things. With VC, it's much more difficult. A lot of those metrics are much more squishy, right? So you're looking at management team, you're looking at potential for a market to grow that is nascent, right? So it's much more difficult to sort of model out. Essentially what you're trying to do when you're creating this model is, okay, how is a venture capitalist going about thinking about valuing a company? And there's so many different inputs that actually are going to affect that valuation, many of which you can't measure. It's sort of a finger in the wind type of a thing sometimes. But what we did find when comparing it to the Russell 2000 Growth Index, which is a small cap index, there is some correlation between those valuation numbers, or there has historically been some correlation between those valuation numbers and the performance of that index.
Yeah, no, it seems like a lot of the public valuations have kind of rebounded, I guess, if you look at the stock market. I mean, over the past few months after that really scary drop in March.
Yeah, and that's also one of the things that we kind of found to be a little bit interesting in when we're kind of projecting out based off of historical data, what might we expect in those valuation changes. And, you could expect a decent drop, and they were sort of tempered because of the current moment where the public indexes don't seem to quite be comporting with what we see in other macro indicators, job loss and GDP growth and other things like that. So it's a little bit of an interesting situation that we're in, obviously, that is definitely different from what we saw in the financial crisis.
Speaking of the public markets and the GFC, there's some interesting data that you used to forecast valuations moving forward with what you saw in the GFC and what that trend sort of looked like, and when stock market moved versus valuations. Maybe you could just kind of hit on what you saw there and what the forecast is for valuations over the next 12, 18 months.
Yeah, so what we kind of did was we saw that the relationship between those valuation changes and the actual change in the public market index, essentially the changes in the valuations lagged the public market performance. So essentially, what that says is investors are sort of looking retroactively at public market performance to then price out deals that they're currently working on and will be working on over the next, several months, right? And so based off of that model, we see kind of an expected flattening essentially of the valuations, the median valuations at both the early stage and late stage levels. So, we would have expected potentially a bit more of a sudden drop, but again, back to this sort of odd rebound in public markets, we're seeing more of a initial drop and then sort of a leveling off is what we're projecting out as an expectation.
One thing I'd add on the more recent bounce back in equities and how that relates to our valuation projections is we're really trying to provide a framework here. We're not the first people to notice that public market valuations can drive private valuations, especially at the late stage in venture. But what we can do is tell you to what degree they're influencing them, right? We have that R-squared value, and then we can provide the framework, the equation. And our expertise does not lie in projecting where those public markets will go. We've done some of that here and try to keep it within reasonable expectations. But we really want to empower the user and the reader with the full formula, the full scatter plot. They can go in and they can create their own projections and based on that, understand how it should impact the private markets. So I think that's just an important kind of caveat for how to interpret our projections, right? It's based on where we think the market's going, but that's not where our expertise lies, right? So just trying to shed light on the relationship and then empower the reader to use that in their own workflow.
I would also add to that, we're looking to continue to build on these models. These are single regression models. They're, it's relatively simple, right? So there's, as we've kind of hammered again and again, there's a lot of factors going into these, and so we'll definitely be looking to refine these and make them more accurate.
One of your key takeaways from this was that some venture-backed companies are going to turn to raising debt instead of getting a down round of VC funding. What are the risks involved if they're going to do that, especially with the way the economy is right now?
Yeah, I mean, I think it's a situation where the risks of raising a down round at poor terms, you're going to risk your ultimate payout as a founder or for your employee stock options by taking that, giving the investors more power in a down round with terms that are unfavorable. And debt, while it can hamstring your cash flow down the road, will keep you in the driver's seat as you look to exit and look to kind of ultimately, get your payout from the work you put into your company. So that's a big reason why, and obviously rates are low right now. Startups are not going to be able raise debt at the lowest rates, so it's still going to be impactful for their business. So, but I think, if I'm sitting in the driver's seat of a startup right now, if someone's offering me debt, then that's I think that's the biggest factor, is if I can secure that debt round. And in that case, it's going to be a more favorable option than giving my investors more board seats, or more clawback provisions and ratchet provisions in their term sheet.
Jumping on to the next part of the report, focused on exits and the impact that we saw. There's some more interesting analysis you did here, correlations between the S&P 500 this time on the exit front, which I presume are IPOs, just the late stage companies kind of being more like the S&P 500 than the Russell 2000 small growth. But maybe just walk listeners through, kind of what the overall findings were on exits, and then we can talk about that correlation with S&P 500.
Yeah, in general on exits, we saw pretty significant drops in both volume and value. Value to a greater extent by far. And so, what's kind of interesting in that is when you break apart your M&A exit route versus your IPO exit routes, that, the IPO volume just really tanked last time, during the financial crisis. And that kind of makes sense, right? Because the public markets are volatile. But on the M&A exit side, you had a pretty big drop in value, but the actual volume of deals was definitely, it subsided a bit, but essentially there was opportunity there for acquirers to go out and buy some targets at depressed valuations, and we saw that in the step-up valuations from prior financing to exit with the M&A exits. On the IPO side, we did some projections on, as you mentioned, Adley, correlating the S&P 500 to IPO count. And what we found is there's a pretty strong correlation there, which makes a lot of sense. As the markets get more volatile, it's a riskier environment to take your company public. And so naturally, companies are going to hold off until market conditions improve. And what's particularly interesting about this situation that we're in is, as we have mentioned a couple of times already, the public markets have actually bounced back a decent amount, and are again a little bit sort of don't seem to be reflecting some other broader realities about the economy. So for that reason, we actually, our projections actually gave us some rather surprising numbers on how many VC-backed IPOs we should expect, and we did sort of a low projected count and a high projected count based off of some consensus analyst estimates for where the S&P 500 will end up at the end of this year. Kind of carried that forward. And so it will be really interesting to see kind of how that actually shakes out, and how the public markets, whether they continue to remain relatively strong in the face of everything else that's going on.
Yeah, I just want to go back to a comment you mentioned on the difference between the value of exits versus the volume of exits, and that you've done some analysis and looking at actually exit values dipped below most recent round valuations for a year or two there. Do you anticipate that happening again, or do you think sort of what we're seeing with the public markets and maybe what people learned during the GFC in terms of exit environment and the ability, if possible, just to hang on for another year, that things could look a lot better?
Yeah, I guess we wouldn't be surprised if that happened again, if a lot of those valuations for the M&A exits are going to be actually below the prior financing valuation. There's been a little bit of hand-wringing over the past several years that valuations are just too high to begin with on, venture rounds, particularly at the later stage. So, I'm not necessarily the one to make that judgment, but you could see a world where a lot of those companies who then are going to seek an M&A exit actually go for a lower price. Yeah.
One trend that might prevent that from happening again is just the extended life cycles that we're seeing in venture. So instead of a company exiting at a lower valuation than their last financing round, you might see them raising that debt to stay keep cash flow going and stay private longer. And then the other factor that we're seeing is, valuations are still high in public markets. So that makes the acquisition targets less attractive to the buyers. So you could actually see a reversal in those trends this time around where, volume actually takes a bigger hit than it did last time. There's just fewer exits.
Yeah, given all the uncertainty over the next few months, how did you guys determine what fundraising is going to look like?
We didn't end up actually doing any projections on this one, but what has been interesting to see actually is the first half of 2020 was pretty strong for venture fundraising. But I guess that speaks a little bit to the process of fundraising, right? It's going to take you a number of months, a year to a year and a half or so, to actually be going through that fundraising process. So our assumption is a lot of those funds that have closed are actually, the process has been started months and months ago. And so we're just kind of seeing the culmination of those processes, closing finally in the first half. And so I guess we could expect that it may not be as robust in the second half. Conducting due diligence over Zoom, I would imagine, has got to be a lot more difficult for an LP, particularly on the side of a potential first-time fundraiser. Even to get those meetings to get an LP to take the meeting virtually could definitely be a barrier to some of those fundraising processes.
Yeah, I think what we saw was an extended fundraising cycle, and the funds that were closer to closing at the beginning of the crisis last time were able to secure that funding. And as uncertainty enters the markets, you've got LPs who are less inclined to make those commitments. So, depending on where you are in your fundraising process going into the crisis, if you're close to closing, we see those funds. We see a strong fundraising environment closing in those periods, but it's those quarters afterwards during the crisis where the fundraising cycle is going from 12 months to 16 months, and it's hard to get LPs to make those allocations when they're not as certain what's going to happen with their public allocations and things like that.
To put the LP hat on, it's not something that's really addressed in the report. I know there's some follow-on analysis plan, but what do you think as an LP after reading this report, your take would be on the venture market and, someone's venture portfolio? What should they be expecting in terms of activity? Where should they be concerned? Where are there opportunities?
Yeah, I mean, I think the biggest takeaway for an LP, especially for the funds that they've already committed to venture funds, is just an extended period of time to actually realize those gains and find an exit environment that is suitable to harvest those gains. And then on top of that, everything's going to be extended. The fundraising life cycles are going to be extended. The exit life cycles are going to be extended. So I think that's the biggest thing, is things are just a little bit slower than normal.
Yeah, I'd also say, what we found from the prior crisis is if you're an LP that's committed to some more recent vintages and those funds are able to make some investments during a time of crisis where there's, maybe lower valuations than you'd find otherwise, that can end up actually being quite lucrative as far as returns for an LP. So, there's sort of a potential silver lining to some of that on the allocator side.
What's next on the docket for the quant team now that we've published this report? What are you guys diving into?
A couple things. We want to publish more of these on other areas. I think you'll see a LP-focused report coming out next. We also want to take the research we've done here and apply similar processes to the European markets. But in terms of next iterations of the PE and VC reports we've already published, I think you can expect to see us take a deeper dive into some of those relationships and whether that's through multi-factor regressions instead of single factor, or looking to at least explain whatever our regression doesn't explain in other ways. I think that'll be next steps for us. We're also kicking around the idea of just general market sentiment barometers and understanding, hey, here's 11 factors that influence the venture market. How many of them are positive or trending positively or trending negatively, and start to incorporate some more standardization around these reports that you can turn to and say, in a very easy, digestible way, things gotten better or worse from last time. And so I think that's somewhere we're going to turn our focus before we publish our next version.
Excellent. Well, we will certainly look forward to that. Dan and Andy, thanks so much for joining us for today's show.
Thank you.
Yeah, thanks, guys.
As always, you can go to pitchbook.com/podcasts for the show notes and other relevant materials. I'm Adam Lewis.
And I'm Adley Bowden. Thanks for listening to this episode of PitchBook's Visible Capital podcast. Please favorite, subscribe, and leave us a review on whichever of your favorite podcast apps you're using.